The average true range indicator, it measures the volatility of a market, and that information can help us do several things. We can decide if a market is volatile enough to trade when we compare it to its recent past. We can even use what price to enter on a breakout, where our stop loss should rest, and where to trail our stops to let the market run to larger profits. At Netpicks, one of our constant themes is to hammer home the importance of managing your risk. Without risk management that protects your capital, you are only one losing streak away from flaming out. So as mentioned earlier, the ATR indicator, it measures the price movement of an instrument. Knowing how far a price can move during an intraday session, it's good information for day traders. It makes no sense to enter directional trades if the instrument has already surpassed its average range for the day. Now, day traders who start at the beginning of a session can determine in advance what their expectations should be in terms of profit potential for the day by noting the current reading of the ATR. Now, of course, anything can happen in a market, but by having a baseline, I think it's a great start, and traders can monitor the price action to see if they see a higher volatility day shaping up. Now, the calculation involves two steps, with the first one finding the true range of the instrument. You can see that right here. For a 14-period ATR setting, which is the default, the last calculation is this one here. And you should not compare the ATR readings of one instrument to another. Each reading should be a standalone information for the instrument that you are trading. And from the final ATR number, we can see if an instrument is becoming more or less active when we compare it to its recent past. And this includes small time frames, such as the 5-minute charts, up to the large time frames. Knowing if you're looking at an instrument that is showing lack of price movement, that can help you determine if this is a market that you're going to trade. Some traders will determine the low ATR reading is a great time to look for a trading range, and then they'll monitor that for a breakout. Other traders will see a falling ATR reading on an instrument as lower profit potential, lack of momentum due to the lack of market volatility. Now, there's no right or wrong meaning to your decision of what the ATR reading is for you. The key is to be consistent in your approach, and everything should be contained within a tested trading plan and used with a trading strategy that has an edge in the market. And there are a few different methods of using the ATR, even as a standalone trading strategy, but I want to hit on two things that you can start testing today. You can see immediate positive results when applying these two techniques, and the first one is letting your profits run. And one of the easiest things for a trader to do is hit the close when they see decent profits on their trade. And this is really common among undisciplined traders and those that have long losing streaks. Exiting your trade when the market still has momentum and potential is just as bad as letting your losing trades run. We want to milk as much as we can from the market until we see signs of a change of character of the market. And one use of ATR is a trailing stop. And the logic is that if a market moves adversely against you in line with the average range of the market, you may be seeing a shift in the underlying driver of the instrument. On this chart here, I added a 14-period ATR to the bottom and on the price portion. And this indicator calculates the price point for the trailing stop. For short trades, the calculation is from the close of the candlestick plus 2 times ATR. So in this example, we have a basic trading strategy of a breakout pullback in the context of a downtrend. And you can see if you sold in the range or at the breakout, price fell strongly to the downside. Now the ATR trailing stop is calculated at every candlestick close, which allows you to take advantage of this move until adverse price action takes you out. The plus side to the exit is that you're being taken out when the rally is showing strength to the upside after the down move has exhausted the current trend direction run. You can set stop losses at objective price points. Setting your stop loss, it's vital to protecting your capital. And while some traders will keep a mental stop, the main point is that knowing where to exit when prices pulling against you is vital. And the key is to find a place on the chart that takes into account the momentum in the market. It allows for the ebb and the flow of price movement, and to exit your trade, perhaps at a loss, when the trading conditions are not optimal. And the way to do it is to use a multiple of the ATR to set your stop loss. So by doing so, you are respecting the volatility of the market, and you are not keeping a tight stop simply to increase your position sizing. So the first step is a pullback trade to previous resistance in this example here. So what you should see is the trailing stop ATR. It's too close to price. So we need to use the ATR from the indicator below. So let's assume that you enter on the green candlestick with the arrow. Calculate 2 times the ATR. Take the closing price of the candlestick and subtract the ATR. But something to consider here. When we consider ATR, we are referring to the range of price where the highs and the lows are used in the calculation. You are going to have to determine, using this example, whether you would use the closing price of the candlestick or the high in the case of a buy trade setup. And there will be times where there's not much of a difference in the price. On the right side, considering a breakout trade, the stop location using the 2 times ATR plus the closing price of the candlestick with the arrow is close to the trailing stop ATR. So is ATR right for you? Well, it doesn't matter whether you day trade or you swing trade. Having an objective measure of the volatility of an instrument can go a long way in how you engage with the market. Trailing your stop is something that many traders do, and oftentimes they will use price structures such as support or resistance. And as I wrote about before in regards to failure tests and trap traders, price can breach these zones without invalidating the trade. So you will be taken out of the trade at the exact moment that you really should be entering. We cannot argue that letting your winners keep on amassing profits until the market changes character is the only way to get alpha. If you are trading without an initial stop loss, you are flirting with disaster. Knowing where you will exit if a trade does not get positive feedback soon after entry, it's key to managing your risk and protecting your trading account. Using an ATR stop, it helps keep you out of the random fluctuations of the market until the trade gets in gear. You don't have to wait until the stop gets hit if you're seeing strong price action against you, which could simply mean you were just too early on the trade entry. Regardless of your use of the ATR, knowing the range of your instrument can help you decide whether to keep it on your list of instruments to trade or set it aside until the market wakes up again.